Yang. Let me start with the headline. Vietnam delivered a very strong first half of 2026 with momentum across all the major parts of the economy. GDP grew 8.18% year-on-year, with Q2 accelerating to 8.39%. Industrial production rose to almost close to 11%, the strongest first half results in 2019. Retail and services grew almost 13%. Export reached a record of close to 267 US dollar, and disbursed FDI also set a first half record of 13 billion US dollar. At the same time, the macro backdrop remained manageable. Average inflation was close to 4.4%, below the government's 5% ceiling, and monthly inflation began to ease in June. The key message here is the combination. Production, investment, consumptions, and external trade are all advancing together. That makes the growth picture more resilient than one driven by a single sector or a favorable base effect. Let us now look at the composition, beginning with GDP. The acceleration was led by industry, which grew close to 10%, versus just over 8% in H1 2025. Manufacturing inched higher than H1 2025 to above 10%, while construction grew around 9.5%, a similar pace versus the first half of last year. This is important because the upswing is production-led rather than dependent on a renewed property cycle. Construction is contributing, but factories, power generation, mining, and the investment needed to expand productive capacity are providing a stronger impulse. On the left-hand side, you can see that industrial production reinforces the picture. The Index of Industrial Production, or IIP, rose close to 11% in H1, the strongest first half growth since 2019. Manufacturing on the right-hand side remained the main engine at 11%, but the previous laggards are also improved. Electricity output grew close to 10%, more than twice last year's pace, while mining swung from a negative number to a 6% growth. So this is not simply a narrow surge in one group of industrial production. Manufacturing remains strong, while the supporting sectors are catching up, giving the industrial expansion a more durable foundation. That is also consistent with the business and investment indicators. So on the left-hand side, the forward-looking indicator, manufacturing PMI, has stayed above 50 for 12 consecutive months. The monthly readings have varied, but the persistence in expansion territory indicates that firms have continued to be optimistic about the future outlook, despite an uncertain global backdrop. Registered FDI surged above 60% year-on-year, while disbursed FDI rose to a record of 13 billion US dollar. The distinction matters. Registered capital represents the future project pipeline and is forward-looking, while disbursed capital is a more immediate and strong evidence that commitments are moving into factories, equipment, and employment. When both measures are moving in the right directions, we can expect sustainable external investment into Vietnam. This supports our view that industrial momentum can extend beyond the first half, rather than fade after a short rebound. Moving to the domestic consumption side, the stable anchor of the economy also strengthened through the first half. On nominal term, retail and services sales grew about 13%, the strongest H1 result since 2019. And more importantly, the pace accelerated from 12% in Q1 to close to 14% in Q2 and reached close to 15% in June. A firm consumer provides an important domestic counterweight to external volatility and broadens the earning backdrops beyond exporter alone. Investment is one of the clearest strengths in the current growth mix. All three engines expanded at double-digit rates. This composition is very encouraging. The state is providing a dependent floor to infrastructure, while private capital is growing slightly faster and acting as the accelerator. This suggests public spending is helping to crowd in rather than crowd out business investment. The fiscal position gives the government room to maintain that support. Budget revenue rose 7.4%, with 60% of the full-year plan collected by June, and the budget is in a healthy surplus of approximately 17 billion US dollar. And again, this is a very favorable mix, with more fiscal resources directed towards productive assets. Good export reached a record of 266 billion US dollar in H1, up 21% year-on-year. That represents more than 46 billion US dollar of additional exports in only 6 months. The result is particularly strong because it follows close to 15% growth in H1 last year, and it comes despite an uncertain global environment. It reflects Vietnam's expanding manufacturing base, continued FDI capacity, and its increasingly important role in regional supply chains. Nevertheless, we did see a faster pace in imports, which tilted the trade balance into deficit for H1 2026. On the left-hand side, you can see that Vietnam recorded a good trade deficit of about 16.7 billion US dollar in H1 as companies accelerated imports and inventory stocking. However, when you look at composition, it makes it less concerning than the headline suggests on the right-hand side. Only 6% of imports were consumer goods. Machinery and equipment accounted for 56%, while raw materials and fuel made up 38%. So in total, 94% of imports were input for productions, partly because of concern about higher logistic costs and supply disruptions. And it's also usually seen as a pre-stocking activities to prepare for releases of new electronic models in the later part of the year. It is therefore, in our view, more investment-driven than consumption-driven. As PMI and export orders remain firm, these imported inputs should support stronger output and trade volume in H2. We therefore see the deficit, which pulled down GDP in the first half of 2026, to be a catalyst for a stronger GDP in the remaining part of the year. Going to inflation, there was some initial concern with inflation as oil and gas prices surged in March and April. But we can now see that inflation is moving into a more favorable direction at the end of H1. For H1 as a whole, average inflation was 4.4% and core inflation was at 4.1%, both well below the 5% ceiling that the government set out at the beginning of the year. We would like to touch on a topic that is usually a concern for investors, which is energy security. The immediate priority is not only to add generating capacity, but also to ensure that the transmission grid can deliver reliable output to the main industrial centers. Current plans indicate that supply is being secure across regions, while the longer-term energy mix become more diversified. Renewables are expected to rise around from 52% to 69% of planned capacity by 2030, alongside greater use of other sustainable sources and the revival of nuclear power. Execution remains a key issue here, but the direction is clear. To conclude, we continue to forecast real GDP growth of roughly about 9.3%, with industrial production and construction growing at close to 11% and services at 9.5%. This requires a further acceleration in H2, so execution remains a key factor to watch out for. The key drivers in our view will be public investment disbursement, conversions of imported inputs into production and exports, continued private and FDI investment, and reliable power supply. We believe that this strong macro environment creates a supportive backdrop for corporate earnings and confidence. On balance, we remain optimistic on Vietnam's 2026 growth trajectory.